Hey option traders, for today's trade we're looking at a bearish option play in payments company and Venmo parent company PayPal. Taking a look on MarketSmith, the stock has been on the decline since July of last year. That's when the bullish uptrend stopped and shares began trading sideways. Then in September, the stock moved below its 10-week moving average, a sign of weakness. Shares have then found resistance at their 10-week line multiple times since then and have fallen over 61% so far in 2022 through Wednesday, June 29th. Both earnings per share and sales have been decelerating in terms of year-over-year growth. Sales growth has fallen from 13% to 7% in the most recent quarters, while earnings per share has fallen from a 3% increase to a 28% decline in the most recent quarters. This compares with sales and earnings growth of 31% and 85% in the same quarter a year earlier, respectively. For 2022, things don't seem to be getting much better. Full-year earnings are expected to come in at $3.86, a 16% decline from earnings in 2021. We're going to be looking at an option strategy that is a bearish assumption known as a bear call spread today in PayPal. A bear call spread is an excellent strategy for beginners and is used when investors expect the underlying stock price to fall. So remember, with options, there are two types of options, calls and puts. With both calls and puts, you can either be a buyer or a seller. Just like with any stock, you can either buy long or sell short. A bear call spread is a credit spread, which means that you will collect a premium upfront for initiating the trade. For this trade, we are both buying a call with a given strike price and selling a call with a lower strike price simultaneously. Together, they create a spread. Both calls are on the same stock and have the same expiration date. But the difference in strike prices creates a range. The investor can expect a profit or a loss based on where the stock finishes within that range upon the option expiration date. For the bear call spread, we expect the stock to go down between now and the option's expiration. The investor nets a credit for putting on this trade, meaning you are paid a premium up front. Since calls lose value as the underlying stock falls, both options would expire worthless if the underlying price finishes below the lower call strike. Here, the maximum profit would be achieved and would be the total premium you initially received. But on the downside, if the stock price moves above the higher strike call option, both call options would have lost money. The maximum loss for the strategy is then realized. It's important to know your potential gain, loss, and break-even points for the trade. This will depend on the width between the two strike prices of the calls in the spread. For example, buying a 70 call and selling a 65 call creates a spread that's $5 wide. If the bear call spread collects a $1 credit, the maximum gain is $1 times the 100 shares of stock each option contract represents. So the maximum gain would be $100 if the stock price is below the short call at expiration. The maximum loss would be $400 if the stock price is above the long call at expiration. Take the spread width minus the premium received and you have your max loss. The break-even point would be the short call strike plus the premium received. Let's talk a couple of rules for taking profits. First, if the trade has achieved a profit equal to 50% of the premium received, that can be a great time to take profits and move on to the next opportunity. This is particularly true if the profit comes in the first half of the trade. On the other hand, when a bear call spread moves against you, don't allow the loss to get bigger than 1.5 to 2 times the premium received. A second rule to consider is rolling a losing trade out in time to the next expiration. The next expiration could be a weekly or monthly option. The main thing to remember is that you only want to roll for a credit. Rolling out in time means tying up more precious capital for another week or even a month, so it's essential to receive a net credit for the extra risk being taken. Let's take a look at my trading platform now and set up this trade with PayPal. So to set up this trade, we're going to first use PYPL, which is the ticker symbol for the stock. And make sure that you are in the August 19th expiration date. And if you're on Thinkorswim, you can select vertical as the spread type here in this box. We're going to be looking at this side of the screen, which has the strike, or which has the prices for call options, because this is a bear call spread. And clicking on any one of these will open up a trade box down below if you're using Thinkorswim here. And no matter what platform you're using, just make sure that you are selling the 75 call and that you are buying the 80 call. And even though this strike price grouping here is not 75 and 80, it's 75 and 77.5, you can adjust on Thinkorswim the specific strike price that you want here. But we're going to go with the 80 strike price that we're buying because this nets a better credit. We're looking at selling the August 19th 75 call and buying the August 19th 80 call to create the spread. Selling these two options generates roughly $185 in premium. The trade is a maximum risk of $315. The spread will achieve the maximum profit if the stock closes below 75 on August 19th, in which case the entire spread would expire worthless, allowing the trader to keep the $185 option premium. The maximum loss will occur if PayPal closes above 80 on August 19th, which would see you, the premium seller, lose $315 on the trade. A stop loss could be set if PayPal trades above 75 or the spread value rises from $185 to $3. This is a bearish position, so if you think PayPal is going to move higher, I wouldn't recommend entering this trade, obviously. As always, remember that if you are new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. Be sure to check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.